Okay, Module 2 homework solution for question 5. Again, question 5 is a continuation of question 4. We're now at the end of our first and second years of ownership, and we need to do the consolidation at the end of each year. So for 2018, the end of the first year of ownership, Little has earnings of $100,000 and pays dividends of $30,000. In 2019, Little reports earnings of $150,000 and pays dividends of $30,000. And there's the trial balances for Big and Little organized into the 5-column worksheet. Let's go ahead and do our equity method entries first. Again, for equity method, we have income and dividends. Little reports $100,000 of earnings. Big owns 100% of Little, so they report $100,000 of investment income. Little pays $30,000 in dividends. Big receives all of them and uses that as a reduction in their investment account. Elimination entries. Again, S for our initial or start entry to eliminate the subsidiary equity. We eliminate the subsidiary's beginning of year owner's equity accounts. And again, I can't stress enough, common stock and paid in capital in excess of par, $100,000 and $50,000 from down in the bottom of the balance sheet. The retained earnings figure of $150,000 is from the beginning retained earnings up in the statement of retained earnings, about a third of the way down the worksheet. It is not the ending retained earnings provided down in the balance sheet. That beginning of year value of $300,000 represents the beginning of year balance in the investment in Little. Again, if you'll note in the trial balance, the investment in Little account has a balance of $370,000. It might be helpful to go ahead and set up a T account showing where that $370,000 came from. That was the beginning balance of $300,000 from the acquisition. They added in their $100,000 of investment income, and then they took away the $30,000 from when they received the dividends. So basically, we're going to eliminate that $370,000 investment balance in three discrete steps. We're going to eliminate the beginning of year balance through this S entry. A for amortization, not applicable. I for investment income, we're going to go ahead and eliminate another $100,000 of that investment in Little balance when we eliminate the investment income. And then D for dividends, we eliminate the last part of that investment in Little by, again, we eliminate the subsidiary's dividends declared with a credit, and we debit the investment in Little. Now we need to post these to the worksheet, and I have a choice here. I can either make the font smaller, or I can leave off the zeros for the elimination entries in the debit and credit columns, and I chose the latter so that this will be more visible. Those numbers under the DR and CR columns, those are in thousands. So again, we're simply posting our debits to the debit column and our credits to the credit column. The I entries, a debit to the investment income, a credit to the investment in Little down in the balance sheet. D for dividends, a credit to dividends declared about 40% of the way down, and a debit to the investment in Little. And now we go ahead and work our way across and down the worksheet. Adding across our various revenue and expense accounts, we simply add across with no adjustments. The investment income account has to go to 0. That is sort of a check figure that's built into this. If in a more complex problem, we do our elimination entries, add across the investment income column, and come up with something other than 0, then we've made a mistake somewhere and we have to, go back and check our work. And then when we compute the income, again, we work our way down the consolidated income statement. $1.1 million of revenues minus $900,000 of expenses is $200,000 in income. If we were to add across the net income row, we'd have $200,000 plus $100,000 or $300,000. And again, the problem would be that we'd be double counting Little's earnings, because Little's earnings are also included in Big's earnings via their investment income. Once we get the net income, we transfer that down to the statement of retained earnings as income. And then we go ahead and work through the statement of retained earnings, adding across beginning retained earnings, and of course we eliminate the subsidiary's beginning retained earnings. We add across the dividends row, eliminating the subsidiary's dividends. And again, we work our way down. Whenever we're going to get a subtotal or something, we work our way down the consolidated column. So our ending retained earnings will be $550,000, which we then transfer down to retained earnings on the balance sheet as ending retained earnings. Now we can go ahead and start working through our assets and liabilities. Again, cash, receivables, and inventory we simply add across with no adjustments. Our second check figure is that investment in little account has to go to zero. If when we add across the investment in little column, the investment in little row, that doesn't equal zero, then again, we've obviously made a mistake somewhere and we have to go back and double check either our elimination entries or how we posted them. The remainder of our assets we simply add across. Likewise with our liabilities, we simply add across with no adjustments. And then for our equity accounts, again, we always eliminate the subsidiaries paid in capital accounts. So we've eliminated the subsidiaries common stock, being left with the parent's common stock, and we've also eliminated the subsidiaries paid in capital in excess of par, being left with the parents paid in capital in excess of par. Moving on to 2019. For 2019, please note that the 2018 ending retained earnings became the 2019 beginning retained earnings. Before going any further, let's go ahead and fill in the big and little columns to get income, ending retained earnings, and so on. So first we work our way down the income statements. Big has net income of $290, little has net income of $150. We transfer those numbers down to the statement of retained earnings. And then we work our way down to get ending retained earnings, which we then transfer down to the balance sheet as ending retained earnings. Okay, let's go ahead and record our equity method entries and elimination entries. First, our equity method entries, income and dividends. The little company reports earnings of $150,000. We own all $150,000 of that, recording that as an increase in our investment and as investment income. Little pays $30,000 in dividends, of which we receive 100%, and again, that reduces our investment account. Next, our elimination entries. And before going any further, please note that it's extremely important, both for your sake and mine when I look at your work, that you make a clear and obvious separation and distinction between your equity method entries and your elimination entries. The equity method entries are actually recorded by the parent in their ledger. The elimination entries are simply worksheet entries. So, never the twain shall meet. In any event, our elimination entries, we eliminate our beginning of year owner's equity accounts, again, common stock and paid in capital in excess of par, and our beginning retained earnings of $220,000, and we close that against the parent's investment in little of $370,000. And just to note, that $370,000 investment in little balance, that was last year's end of year investment in little, or this year's beginning of year investment. So in a sense, what we're doing is we're sort of picking up where we left off at the end of last year. We're going to go ahead or at the beginning of this year, we're going to go ahead and get rid of this year's beginning of year equity balances for little, and we're going to go ahead and get rid of big companies' beginning of year investment balance. A for amortization, not applicable again. I for investment income. Now, as these problems get more complex, sometimes people make this entry much harder than they have to. Basically, if you look at the worksheet, the fifth line down says investment income $150,000. That's what you have to eliminate. As we get into more complex problems where there are numerous things affecting investment income, people try to keep track of it, and there's no harm in trying to keep track of it, but people try to keep track of it separately, when in fact it's really nothing more or less than simply looking at the income statement saying there's $150,000 of investment income, that has to be eliminated. So we eliminate the $150,000 of investment income against the investment in little. And then D for dividends, we eliminate the subsidiary's dividends declared against the investment in little account. Now again, we post these things to our worksheet. And again, I've left off the zeros in the debit and credit column. So we eliminate the subsidiary's beginning of year equity accounts, including their beginning retained earnings. I can't stress that enough. We always adjust beginning retained earnings, and then sort of let that adjustment flow through to ending retained earnings. And we credit the investment a little. The I for investment income entry, and the D for dividends entry. Now again, these problems at this point are still fairly straightforward, but it might not be a bad idea to get in the habit of footing the debit and credit columns to make sure that your debits equal your credits. Obviously, in the elimination entries, the debits have to equal to credits. At this point in our careers, it should be, you know, a soul-crushing experience if we were to mistakenly record a journal entry where debits didn't equal credits. So if your debits equal credits in your elimination entries, then when you post them to the debit and credit columns of the worksheet, the debit column should equal the credit column. If they don't, then that's a sign that you either forgot to record half of an entry or perhaps put something on the wrong side. So again, take the 30 seconds to add up the debit side and the credit side of those columns just to make sure they're equal. And now we start adding across again. Again, sales, cost of goods sold, and operating expenses, there are no adjustments, so we simply add across. And as always, the investment income account goes to 0. We then work our way down the consolidated income statement to get net income of $290,000, which we then transfer down to the statement of retained earnings. Now we work through our statement of retained earnings, carrying across the beginning retained earnings, carrying across the dividends, and working our way down to get ending retained earnings, which we then transfer down to the balance sheet as retained earnings. And now finally we can work our way through the rest of the balance sheet accounts. Cash, receivables, inventory, we simply add across with no adjustments. The investment in little account has to go to 0. Again, if you find yourself adding across that row and it doesn't go to 0, you've made a mistake and you have to go back and find out what went wrong. The remainder of our assets and our liabilities, we simply add across with no adjustments. And the equity accounts we add across, eliminating the subsidiaries' equity accounts, leaving us with the parent's common stock and paid-in capital in excess of par.